Brian, in this era we have Boeing aircraft, and a lot of people were let go from Boeing, or they were separated. They had buyouts, that sort of thing. One of the big decisions that someone needs to make when they have this situation is whether they should take a lump sum versus a monthly pension. How do you help someone with that?
Yeah, it's an interesting area, and I think there's a lot of guidance that isn't really accurate given out there, so I want to address that. And this is not just for Boeing workers. This could be for anybody that has a choice between taking a company pension or a government pension or taking a lump sum distribution instead. There are pros and cons to each, and so we want to kind of address that. So the first thing is with a pension, a typical pension like a Boeing pension, let's say just keep it simple, you're a single person and you decide you're going to take the pension. Well, whatever you get, you're going to get the same amount for the rest of your life. If the rest of your life is 10 months, you're going to get checks for 10 months. If it's 30 years, you're going to get checks for 30 years. So there is a legacy or a longevity aspect to this we have to consider. The alternative is you can take a lump sum, invest it yourself, and take out money on your own. So this involves more risk, but potentially higher returns. So that's the rub. Nothing's perfect. You can have security of knowing I'm going to get checks for life, and if you're married, you can choose some options to cover your other spouse. But once you've both passed away, there's nothing left for your heirs. Or if you want to leave money for your heirs and you want it to grow at a reasonable rate, you would take the lump sum. So again, advantages and disadvantages to each, and at any given time or between any analysis of this, we would sit down and do some computations to share with you as to what your break-even point is.
Brian, is there any set rule that goes into whether you should do one or the other, or does it just vary according to the individual?
Well, it varies according to the individual. Sometimes it's easy for me. So for instance, let's say we have somebody that says, I'm really nervous about the market. My mom is 80, my grandmother's 103, and I think I'm going to live at least as long as they're going to live. I'd say, well, you're an easy one. I would take the pension. You're going to live a long time. You want to take that. Someone else says, you know, I don't have longevity in my family. I want to leave a lot of money to my kids. So, you know, that was another easy call right there. I'd say, well, take the lump sum. Now, another interesting thing is to figure out what your break-even point is. I just mentioned that. What does that mean? That means, let's say I'm 60 years old and we do the computation and we say, well, if you take the lump sum, they will pay you monthly. If you don't, the amount of the lump sum, and you'll get that amount by the age of, say, 80. Is that okay with you? Anything after 80 is a gain. Anything, if you die before 80, it's a loss, assuming no earnings on your investment. And you might go, oh, well, maybe I'll just invest that money. I'll do better, and I'll take my money out that way. So, you know, there's different situations for different people, but knowing that break-even point, and the payouts change over time. I know Boeing used to have a very, very unattractive lump sum payout. And now, with interest rates being low, it's becoming more attractive for some people. So where I might have advised something 5 years ago, I might advise something different now.
If you take the guaranteed monthly payout, do you often give up the upside potential?
Yeah, there is no upside potential and no residual. You are signing up for, there is nothing to be left to anybody when I pass away or when my spouse passes away when you sign up for that. So it is a life-only annuity in the Boeing plan. You can, you know, maybe your plan could offer something somewhat different, maybe a period certain aspect of it. But generally pensions go away when somebody passes away. So that's why a lot of people might go, well, you know, I understand I can get the maximum cash flow by taking the pension, but I still feel like maybe I have other assets, plenty of other assets to turn to, whether it's real estate, DSTs, REITs, stock market, whatever, that I think I would rather just take the chance on investing, and over time I'm going to have a decent rate of return. I'll have a lot more money in the long haul having taken the lump sum. So a lot of it comes down to your investment experience and how you feel about risk and the other assets in your portfolio. And that's why this is part of, you know, when you're doing an integrated financial plan, you want to check into all this information. But it's not always an easy call as to which one you should take, but a lot of it has to do with your thoughts on security, cash flow, and longevity.
How do taxes play into these two choices?
Well, both can be the lump sum can be tax free, so that would be rolled into an IRA, and it can grow tax deferred there. So hopefully it's not a big taxable event. It's not like they're going to give you a lump sum and all of a sudden you have $400,000 to put on your tax return, so that's not a problem.
Brian, thanks for telling us more about taking the lump sum versus the monthly payout.